Hey everyone, and welcome back to the channel. Today we're going to talk about what to expect in the stock market mid-2022 beyond. Let's get right into it. Economic uncertainty may have peaked in the first half of 2022, but it remains high. Stocks are likely to feel the weight of Federal Reserve policy tightening, shrinking market liquidity, and slower economic growth. In the first half of 2022, the US economy and stock market struggled. The S&P 500 index was down 21.3% on June 13th, despite a multi-decade high in inflation, aggressive monetary policy tightening by the Federal Reserve, and the effects of the Russia-Ukraine war. Sharp counter-trend rallies may continue this year, but aggressive Fed policy, a turning of the liquidity tide, and slower economic growth are likely to keep stocks under pressure. Beginning with the COVID-19 pandemic in March 2020, the US economy and assets markets benefited greatly from the epic jolt of trillions of dollars in liquidity provided by the Federal Reserve and Congress. With that liquidity now dwindling, the Fed began raising short-term interest rates in the first half of this year. Many are wondering if a recession is imminent. Lessons from history about the impact of Fed rate hike cycles indicate that a recession is more likely than a soft landing. Although the S&P 500 index entered bear market territory in mid-June, many of its underlying stocks, as well as the Nasdaq and Russell 2000 indexes, had been in bear markets for some time. Bear markets are characterized by short, sharp rallies within an underlying downward trend, so investors should brace themselves for increased volatility. Weakening earnings and profit margin expectations may cause the market to fall further. Meanwhile, this is not a market that rewards excessive risk-taking, and experts continue to emphasize the importance of diversification as well as the power of periodic rebalancing, that is, trimming investments that have grown beyond your target allocation and buying more of investments that have become underrepresented. Experts also believe that stock-picking investors should focus on factors, particularly quality-oriented factors, rather than sectors or traditional style indexes. Given high inflation, rising short-term interest rates, and weakening growth forecasts, experts believe stocks exhibit certain characteristics will outperform in relative terms. These characteristics include strong free cash flow, healthy balance sheets, positive earnings revisions, and low volatility. Now, when markets become more volatile and weakness replaces strength, experts remind investors that panic is not an investment strategy. For fixed income investors should see higher returns in the second half of 2022, now that interest rates have been reset higher. Experts predict that volatility will remain high as central banks abandon easy money policies. Experts predicted rising interest rates and increased volatility at the start of the year, and they were correct. Experts, on the other hand, did not expect it to happen as quickly as it did. Experts predicted that it would be a more gradual process. However, the Ukraine war caused energy prices to skyrocket, and supply chain issues lasted longer than expected, causing inflation to skyrocket. The risk of recession is increasing, as it is with any tightening cycle. Based on previous tightening cycles, the Fed's chances of achieving a soft landing for the economy are slim. Only 2 tightening cycles in recent history avoided a decline into recession. Even with the increased risk of a recession, it is worth noting that each one is distinct. The current situation appears to be most reminiscent of the early 1980s. Oil price spikes contributed significantly to high inflation. In response, the Fed aggressively raised nominal and real interest rates. The economy was otherwise in good shape, with a strong banking system and consumers who were not overly in debt. Despite this, there were 2 severe back-to-back recessions during that time period, from January to June 1980 and July 1981 to November 1982. Housing and manufacturing suffered sharp declines, and the unemployment rate climbed into the double digits. While the Fed is determined to reduce inflation, it is unlikely to have to go to the extreme seen in the early 1980s. With the aging of the US population, demographic trends are very different. This leads to slower growth and higher inflation. Another significant difference in policy this time round is the Fed's use of forward guidance. In the 1980s, the Fed gave the markets very little information about its plans. As a result, rate increases frequently surprised investors, consumers, and businesses, increasing volatility. This time of year, markets should be able to anticipate changes, reducing the surprise factor that can cause additional volatility. There are also concerns about global stocks and the economy. Although economic uncertainty may have peaked in the first half of 2022, it may continue to contribute to volatility and affect market performance for the rest of the year. Global stock markets fell in the first half of this year as economic uncertainty increased due to the European Union's war. A lockdown-induced recession in Asia's largest economy, persistently high inflation, and several major central banks pursuing the most aggressive series of policy rate increases in decades. When measured in US dollars, only the commodity-driven markets of Canada, Australia, and the United Kingdom performed noticeably better than others. This year, experts have been recommending strategic weights across asset classes and sectors, not because they lack ideas, but because diversification is an especially good idea right now, in this period of heightened volatility. The correlation between stock markets has dropped to its lowest level in 20 years, and portfolios benefit from diversification as sectors and markets move more independently of one another. That's it for today. If you guys enjoyed the video, make sure to hit that like button. Don't forget to subscribe and turn on that notification bell so you never miss out on any future content we'll produce for you guys. We're signing off now, but we'll be sure to catch you all in the next one.